Hello, welcome. Warren Buffett is widely considered by most to be the greatest investor of all time. So it's no surprise that his decisions are widely followed by markets. On August 3rd, Buffett made shockwaves by revealing he'd sold about 50% of his stake in Apple shares, worth around $88 billion over the second quarter 2024, after he had already made a reduction of Apple in the first quarter of 2024, overall taking a huge profit and reduction in his position by about 50% during the first half of 2024. So while a reduction was expected in the second quarter after he'd reduced a small amount in the first quarter, the huge amount that he reduced was certainly big news. Buffett's substantial change of mind has generated many questions from investors. Firstly, regarding the future of Apple's stock specifically, but also broadly, is Buffett calling a top in tech stocks, the Magnificent Seven, for example? Or is he actually worried about something even more broad, that the entire market is too expensive? This last point is further evidenced by his gargantuan cash hoard of nearly $300 billion, meaning he could buy Disney stock, Starbucks, and Airbnb entirely and have some cash left over. Having the news of Buffett reducing his stake in Apple by such a significant amount hit at the exact same time when markets were having a huge sort of shakedown based on the yen carry trade and weaker US jobs data, sent a much stronger shockwave to investors. So let me try to explain the most likely reason for Buffett's sale and why he's changed his mind on Apple specifically, and some key lessons we can all learn from the great Oracle of Omaha. So what are the details of the sale that shook markets? When Buffett's company Berkshire Hathaway released its Q2 earnings and announced it had sold nearly 390 million shares of Apple in that quarter, on top of the 115 million shares it had sold in Q1, Berkshire said it still owned around 400 million shares, worth about $84 billion at the time. Therefore, still remains Berkshire's largest stock holding. It's close to 30% of his stock portfolio, more than double his second position of Bank of America, which he's also been selling. At its peak, Apple was nearly 50% of his stock portfolio. The key point, though, that many media members forget to mention is they put these headlines out that Apple is 50% of Buffett's stock portfolio, but they don't point out that Buffett owns a lot of companies outright, or a lot of private companies in like a majority stake. So Berkshire has a listed stock portfolio worth about $350 billion. He also has a private holdings portfolio where he owns Geico and other big companies where he owns them outright or he owns a significant share. About 60 of them, if not, I think more than 60, maybe even as many as 70, of non-listed companies, and that portfolio is worth another 300 or 400 billion. Hard to know because they're privately listed. And then when you add on his cash of another 300 billion, it takes his whole empire up to $1 trillion. So for him to own 84 billion of Apple, it's only actually 8.4% of Berkshire Hathaway, not the 50% that the headlines actually grab. So the other key point in that information is to know that having nearly 300 billion, I think it was $280 billion of cash, means that Buffett is holding about 25% of his $1 trillion empire in cash. Now that's not overly unusual because he's on average always holding about 14%, but 24% is actually very high considering the last 20 years. I think it was something like referenced around 2004 was the last time he had as much as 24% of his total portfolio in cash. So it is worth noting that he is sort of on the sidelines ready to go bargain hunting. Another small lesson to take is where Buffett keeps his cash. It's almost all held in short-term US Treasury bills, which are now paying around 4.5–5%. It's roughly $235 billion. Funnily enough, is even more than the US Federal Reserve, the US Central Bank, actually holds. So Buffett has a staggering amount of US Treasury bills. Buffett's large sale of Apple caught many investors off guard for two key reasons. Buffett has said he likes to buy stocks and hold them forever as a general view. So halving his position runs a bit counter to that. Buffett has also widely praised Apple's management, Apple's products, its ecosystem, the dominance and the moat that it has in its market. So therefore selling half of his position is a substantial change of mind. That said, it's worth noting that in the past Buffett has named stocks he'd like to hold indefinitely, and Apple has never been one of them. Instead, he's said companies like Coca-Cola, American Express, and Occidental Petroleum are companies that he wants to own forever. Buffett has gone out of his way to talk up Apple's stock since first purchasing it in 2016. Buffett's kind words of Apple extended even up till May this year, when Buffett had his annual general meeting and he declared that two of his long-time prized investments, Coca-Cola and American Express, were wonderful businesses, but Apple is an even better one. So to then be selling half of it during that exact same period is an interesting observation. At the same meeting, when asked why he'd sold some Apple stock during the first quarter, Buffett alluded to some tax rates as a reason for that sale, and thus taking profits now was going to be more tax advantageous to doing it later. He said something along the lines of US may raise capital gains tax in the future to plug their climbing fiscal deficit, and therefore he wanted to take all those huge profits now before he might have a future larger tax bill. The big question: why is Buffett selling Apple now? There's been much commentary about how the move indicates that Buffett is calling a market top. In effect, the markets are expensive and maybe it's time to bail out. Yet this seems unlikely, given Buffett has repeatedly said that he doesn't believe in timing markets. He's always focused on stocks, not markets. Yet his reference to taxes as a reason to sell also doesn't make entirely great sense. While it may have made a small part of the decision, it surely couldn't have played a major role. More likely it was to give as an explanation so he didn't have to reveal the true reasons. So what were the real reasons? I think there are 4 probable factors behind the decision. Firstly, Apple is expensive. Not just the iPhone for all of us who have to buy it, but the actual company itself. By any measure, Apple is priced to perfection. It trades at 32 times earnings, meaning 1 unit of earnings is 32 units of value, compared to 10 times 1 unit of earnings. Value was only 10 times when Buffett actually started buying it back in 2016. Plus the price, the value to sales ratio has also moved from just 2 times up to 9 times. That's the highest in the company's history. And Buffett has always been a value investor. He believes in purchasing stocks at a price that offers a margin of safety. Perhaps Apple no longer offers that margin of safety, being so expensive. And perhaps Buffett has learned his key lesson that he often mentions from not selling one of his other beloved shares, Coca-Cola, back in 1998. Back then, Coke's stock soared, reaching 50 times earnings and 11 times sales, as the market had exploded higher. As markets then came back to earth, the shares didn't reach the same 1998 high until 16 years later. Buffett has since made comments to say that he regrets not selling Coca-Cola in 1998. The quote goes, "Coca-Cola is a fabulous company that was selling at a silly price. You can definitely fault me for not selling the stock. I always thought it was a wonderful business, but clearly at 50 times earnings, it was a silly price." Number 2, lacking growth. While valuations may have been one of the key reasons for Buffett selling, a deterioration in Apple's earnings power may have been another. Between 2010 and 2020, Apple revenue grew at a 15% average annual rate. During the pandemic, Apple had a surge in revenue growing at nearly 20% annually, so 21 and 22. However, since 22 until now, Apple's revenue declined almost every quarter. Apple's revenue broke that run just in the last quarter by saying revenues rose by 5%. But relative to history, it's still substantially lacking. So unless something new comes along that can kickstart growth for Apple, Apple's stock being so pricey doesn't make sense. Number 3, is there a chance that Buffett has lost faith in management? He's always praised Tim Cook, but he's also always praised companies doing buybacks when the stock is undervalued. Yet Apple continues to buy back its stock now when the stock is rather overvalued by most measures. So perhaps Buffett doesn't like to see that. I think this is a much lower likelihood reason. I think the first 2 are the key reasons. Although reason 4 is also very interesting. Money is safer in treasuries. It's clear that Buffett assesses the value of stocks against other assets. By buying a huge amount of treasury bills yielding around 5%, he clearly believes that the guaranteed 5% of these treasury bills offer a better risk-adjusted return than Apple stock. This is a good point. Does he see more risk ahead? So where does it leave Buffett and Berkshire Hathaway? Curiosity has already been rampant to what Buffett may do with his near $300 billion cash pile. Buffett has said for many years that he is seeking an elephant of a deal to put Berkshire's cash to work. That need is only greater after the Apple sale. Taking over a whole company is an obvious prospect, as that is what Buffett has done to great result over history. But which company is the key question? So in summary, here are some key takeaways for the average investor. Firstly, it's okay to change your mind. Think about how hard it must have been for Buffett to lavishly praise the stock and then later start selling it. Most people, when taking a strong stand initially, would dig in and find reasons to keep the stock, even if valuations got out of hand. To his credit, Buffett didn't. Number two, price always matters. In a market like today's, there are plenty of people who are buy quality stocks no matter what the price type investors. Buffett has stayed true to his value investing roots. For Buffett, price always matters. Number three, focus on stocks, not the market. Buffett doesn't really get caught up in the noise of markets. He focuses on stocks and their fundamentals, and that's it. Number four, weigh stocks against values of other asset classes. The return versus risk ratio of stocks should always be assessed against other assets. Buffett obviously thinks increasing his stake in treasuries, a guaranteed 5%, is a much better value proposition relative to the risk than holding so much Apple stock. Who knows what he'll do in Q3 though. Number five, be patient. Buffett has been sitting on a lot of cash for a while now, and he's endlessly patient, waiting for the right investment opportunity. This does not mean have 100% cash and sit on the sidelines. Remember, Buffett typically has around 14% average for his cash. So $1 trillion company, over history, that means currently he should be around 140 billion in cash. But after Q2's Apple sale, he's now up to 24%. Therefore, you can invert that number and see that he's still 76% invested in the US economy and global markets. So he's definitely ready to go bargain hunting, but he's also still invested. So thanks for watching to the end. I hope you found today's content interesting. So hopefully you've already subscribed and liked, as I have many more videos to come.